Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is the QQQ. That is the ETF that tracks the NASDAQ. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Callie Cox, Senior Investment Strategist for Ally Invest.
All right, Callie. Well, I am showing the S&P 500 index, and I want to highlight the fact that we did in the last few sessions break down below that 50-day moving average, which is always a fairly important point in the SPX. We are still quite a ways from the 200-day moving average, but we had a lot of news over the weekend. What do you see happening in the markets in general going into the end of the week?
Yeah, Brian. Well, I thought I could get a breather this week, but that doesn't seem to be the case. We're processing a lot of stimulus news now. And like you said, the S&P 500 just broke below the 50-day. So let me recap what happened last week because a lot happened. It was pretty crazy. So last week, the S&P fell to 5% below its record high. It went through 4 straight days of moves bigger than 1%, both up and down. It also went through its biggest intraday turnaround in 10 years on Friday, falling nearly 1% intraday, but then rebounding to close up 2% higher. I mean, whew, crazy. I mean, I had a nutso week. And it looks like we're getting a third round of stimulus now. So we have another, market catalyst that we're considering here. What does that mean? That means more stimulus checks, the extension of unemployment benefits, and more money to governments to speed up the vaccination timelines. All awesome news for the economy, the markets, and to be quite honest, for normal life too. But this is where things get a little tricky for the markets. Believe it or not, this stimulus news may not be the home run positive that everybody's looking for. Investors are obviously very worried about the potential for runaway inflation right now, or inflation that grows faster than incomes that the Fed has trouble keeping under control. That worry has been enough to keep the market tumbling over the past few weeks, like I mentioned earlier. We have seen a lot of high flying stocks like Tesla and Peloton and Zoom down almost 20% since February. Tech has also taken one on the chin, and we'll talk about that in a few minutes. And the NASDAQ 100 is down about 10% in just 3 weeks. Runaway inflation is a legitimate worry too. We pumped a lot of money into financial markets since March, into the financial system, and more cash in the system can definitely lead to higher inflation. It's just more demand, more inflation. You have to remember too that tech and stay-at-home stocks have driven a lot of this market rebound, and there's been a lot of concern about speculation in the market, especially in those areas. So an ounce of worry has been enough for investors to take profits in those stocks. And that's really weighed on the rest of the market. So the $1 million question is inflation going to run away from us? Well, we can't say for sure. We don't know what the future holds. But we don't think it's a big risk at this time. Why? Well, the economy really needs this stimulus. If you think about it, the unemployment rate is still very high historically. And we've seen a few surveys that show that many Americans will use these stimulus checks for necessities. Businesses and local governments, well, state governments, also really need the stimulus help too, especially for vaccination efforts. More stimulus, when you frame it that way, is very, very good news. Inflation is still historically low too. And it's not just because we're working our way out of a devastating recession, although that is true. The US economy for years has had trouble stoking inflation, and inflation hasn't consistently met the Fed's goals of 2% year over year growth for over a decade. There are some theories out there. There are long-term trends like globalization and demographics that could be keeping inflation low, and they're very legitimate theories too. And while we see a lot of truth in that, from the government's view, thinking about it, We're looking at a healing but a very broken economy with no clear sign of inflation moving dangerously higher. So, from the government's perspective, stimulus here does make a lot of sense. And we have faith that the Fed will be able to control inflation if we do see inflation pick up meaningfully or noticeably. Just because of those long term trends and because we haven't really seen inflation stoked as much in the past. So, thinking about the market and taking the stimulus news into consideration, we could see a pullback as the market digests this news. And we are kind of seeing that, we did kind of see that. We have seen that so far with the market selling off towards the end of Monday's trading session. But long term, we expect this stimulus news to be a positive for stocks, even if rates rise and even if inflation picks up. So, Brian, I've talked a lot. I want to hear what you're seeing in the VIX's tea leaves. Tell us about it.
All right. Well, I have my VIX watch list up here once again. And a couple of things that we saw that were interesting today. A lot of people were thinking that the VIX index was maybe staying elevated because Congress couldn't get the stimulus package passed. And it is not 100% passed just yet. It still has to go back to the House to be voted on. And President Biden does have to sign off on it. So there's still a couple of technicalities that have to be done, but it goes back to the House mainly because there were a few changes, but it's expected to pass more so than it ever was previously. So in this instance, we see the VIX index is up about 78 cents on the day. And now I'm going to emphasize that we are taping this on a Monday, so we're not live on Tuesday. So the markets are closed right now. And I wanted to highlight that because on the opening, we saw the SPX actually be up and the VIX index up at the same time, which usually is not the case. Usually they work inversely against each other. If we see the SPX up, we see the VIX down. But the VIX was actually up today. Now, with that said, the VIX or the SPX index actually ended up down 20 on the day. So the VIX right now is still at elevated levels, up around 25.5%, up 81 cents on the day. But I always like to highlight the futures contract, as we usually do here on the stock play of the day. If we look out to May and we look out to April, it's staying fairly stable. Now, May did jump a little bit today. It's up above the 28% level, but the April contract is still below 28, and it was kind of pushing down towards the 27 level in that. If we look out in time, volatility is coming off just a smidge. I'm not going to say it's a lot, but a little bit at least, as I think people are getting vaccinated. But overall, I think you hit the nail on the head, Callie, when you started talking about inflation concerns. If I look at the TXN, which is the actual index that tracks the yield in the 10-year, we do see it up around 1.6%. So that's the highest it's been in a while. And it's kind of hanging out in that range, which is actually higher than the dividend yield in the SPX overall. And that's always a note that people like to talk about a little bit. But that's just showing that those inflationary concerns are just kind of smoldering around the marketplace, keeping that VIX a little bit high, keeping the yields up overall. And what has it done in the NASDAQ? Well, let me pull up the chart of the QQQ here. I highlighted at the beginning of the show that the SPX finally broke through the 50-day moving average. Well, we actually had the NASDAQ, and I'm highlighting it with the QQQ here, break down a few weeks, almost a week ago. It looks like a little more than a week ago. On the 23rd, we actually broke down below that 50-day. We hung out there for a while, but now we are definitely below. We're halfway down to the 200-day moving average. So a lot of people were talking about the market's being a little bit overdone. Well, now we finally got the NASDAQ back into the range that's not really elevated relative to the 200-day moving average. Not saying that it's not in the range of the NASDAQ overall. But if we think about the QQQ, and the leaders, usually the NASDAQ was during the pandemic downturn, actually kind of pulled us out of that big downturn and led the markets higher. We are now seeing a little bit of a sell-off here. So in the QQQ, what would be your analysis going into the end of the week? And then we'll talk about an option trade here.
Yeah, definitely. Well, let's talk tech stocks. It's been quite the interesting space lately. Like I mentioned earlier, tech has had a rough few weeks. Oh, and I'll throw in too. Brian is right. He mentioned something I forgot to mention. The stimulus has not been passed yet. The president has not signed it into action. Everybody expects that to happen, but it hasn't happened yet. So the market is anticipating that a little bit. So very important point. And with that, let's talk tech. So tech has had a rough few weeks. Like I mentioned earlier, the Nasdaq is down about 10% since February, and that's a lot considering the S&P 500 is only down about 5% over the same amount of time. Why is that the case? Well, it's the market narrative around rising rates. So rising rates in the market's eyes are better for value stocks like energy, industrials, materials, sectors like that. Compare that to growth stocks. Growth stocks, if you think about it theoretically, growth stocks, a lot of them trade on future earnings. Value stocks are more exposed to the economy now. Growth stocks are more exposed to the economy in a few years. Tech is a good example of that, by the way. Higher rates, can lower the value of, lower the value of future cash flows. Say that 5 times quickly. And that trend disproportionately hurts the case for tech stocks because many of them, like I said, you're kind of investing on future growth. So that's the main reason why growth stocks have sold off so hard. That, and like I mentioned earlier too, they're the stocks that have done so well. So they're the first place investors are trimming when they want to take profits. But with all the craziness these days, we want to remind everybody that we're still pretty optimistic on tech stocks over the next few years. Why? Well, tech's an exciting sector, and mega tech stocks are some of the strongest companies in the stock market. Companies like Apple and Google have especially strong earnings and balance sheets, and shareholders are really excited about them, and for good reason. There's a lot of promise outside of big tech too, although you got to be careful with the smaller tech companies because their balance sheets aren't that strong or aren't as strong as the mega caps, and they're a little more speculative, meaning they trade a little more on promise than on actual profits, which is okay. You just have to know what you're dealing with. Believe it or not, rates are still very low historically too. And this is another big part of our long-term story on tech. Rates are still very low historically, and that's a great setup for tech when rising rates aren't the front and center narrative in the stock market. While we think rates could keep rising, we don't think they'll rise to a point where tech permanently falls out of favor. The Fed probably won't let that happen for years, if at all, to be honest. So, yeah, it's tough right now to be a tech investor. Tech is sliding quite a bit, and we're not quite sure when the tide will turn. That's the $1 million question. But we think the tide will eventually turn over time. All right, so I've talked about tech stocks. Let's talk about the ETF world. So the biggest and most liquid tech ETF out there on the market is the QQQ. I think we've actually played it before on Stock Play of the Day. So go and check out those episodes. They should be on Ally's YouTube page under the Stock Play of the Day playlist. So the QQQ is a good vehicle to look at if you want exposure to the broader tech sector, especially if you want exposure to big and small tech companies as well, because of its size and its liquidity, its ease of trading in both the fund and the options. So just a reminder, QQQ's holdings match the NASDAQ 100 pretty well, almost exactly. So the QQQ is also down about 10% since February 12th, and its top holdings are basically the FANG stocks and Tesla. Like I said, it provides exposure to tech companies of all sizes and all types, from semiconductors to mega tech to consumer tech. So if you want a little bit of diversification within your tech holdings, not necessarily your overall portfolio, we diversify more than that. But if you want some level of diversification in your tech holdings, QQQ could be the way to go. So to sum it all up, we're thinking long-term bullish in tech, but we're preparing for a little bit of weakness, maybe near term, because again, we don't know when that tide will turn. So let's look at QQQ, Brian. I want you to tell us what you're seeing in options. But before we do, I want to, tell everybody, Brian did mention that this is pre-recorded. So unfortunately, we won't have live questions at the end of the episode. But I do have one question for Brian after you dig into options. So what are you seeing in QQQ options, Brian?
All right. So today's trade, I've kind of overdone the FOMO trade, the fear of missing out trade. So today we're going to look at a long call spread, and I'm going to call this one dipping your toe in the water. In other words, just come on in, let's test the water. The water's fine. You'll be okay. Let's just see where we can go with the NASDAQ via the QQQ. So we're going to look at an out of the money long call spread. We're not as bullish on this trade. We're bullish in that if we do get a bounce back, we're hoping that it will be a strong move back to the upside. But we're going to manage our risk by going a little bit further out of the money. When we were talking about the FOMO trades and just taking a position, on a lot of those trades, we were looking at going a little deeper in the money or on a long spread, basically straddling the market by buying an in the money, selling it out of the money. So what is a long call spread? Well, in this instance, we're going to look at the QQQ. I'll pull up the option chain in just a minute here. But what we'll be doing is buying a strike out of the money. That will be the more expensive strike, but it will be a fairly inexpensive option contract relative because we're going to go a little bit out of the money. And then we're going to sell one a little further out of the money. This way that we can participate if we do get a bounce back in a lot of the tech stocks, we'll participate in it. But overall, we're going to manage our risk by using the spread and going a little bit further out of the money. So we're just dipping our toe in the water here. That's all we're looking to do with options. And that's one of the things that's wonderful about options is we can manage our risk that way by choosing those strike prices along with our strategy. So if I actually look at the Ally Invest option chains here, we see that the market is closed right now. We do have the market closed. And the last trade, it was really nice of them to give us a nice round number, right? It was right at 300 in the QQQ. It's down 7.84 or about 2.5% on the day. So that's a fairly hefty move to the downside for a big index like the NASDAQ overall, which the Qs follow. So I'm going to go out further in time. And normally if I was doing spreads, I like to be a little bit shorter on my duration, but that would be on a more speculative spread in that we're doing this just because we want to protect ourselves. If we're thinking about taking a position in some of these NASDAQ stocks, here's one way that we can take a position now, wait for the bounce back, and then maybe do something a little bit later on. So we're going to look at the April 16th expiration. That's 39 days away, fairly long for a spread overall. We got the Qs at 300. We're going to go to the 305. Now, that's a very plausible price that the underlying could get at. If I look at the long straddle, which means if I bought the 300 strike call and I bought the 300 strike put, they're saying in this time frame, a 24-point move to the upside or downside is very feasible. It's basically the expected move by just looking at what that long straddle is. So we're not going to go that far out, right? We're not going to go 24 points out. We're going to go 5 points out. We're going to lower that cost. Now, if we bought it outright, it's still a little bit too expensive for me to just buy this out of the money option contract, $9.53. So I'm going to go and look at buying the 305, and then I'm going to sell the 310. It's going to give me some upside potential, but that 310 is trading for around $7. So overall, if I do this long spread, dipping my toe in the water here on the tech stocks overall, we're going to be paying $2.40 for it. That means for every 1-by-1 spread that we're doing, every 1-by-1, we're going to pay a net debit of $240 or $240 plus commission to put that trade on. So if I look at the profit and loss graph of this, it looks very similar to the long call spread inside the options playbook, but you'll see a much more flatter line right now because we've gone so much further out in time. So one of the things about doing the spread further out in time is you don't get paid as quickly if you're correct on your forecast. So just want to keep that in mind, but we are a little bit more out of the money than normal. We're looking for at least a 10-point move to the upside on our $300 stock here in the Qs. So let's officially make this the paper trade. And how do we do that? We always put that in the right rail over here. Now, nothing's meant to be a recommendation. We're always just doing this to learn on the stock play of the day. So in general, we put this in the right rail. We're going to say 240 is the midpoint. Like I said, the markets are closed. We're not taping this real time. So we'll try to work this trade. The Qs are one of the most liquid underlyings in the marketplace. So getting midpoint fills is a little bit easier than an individual stock, but it's never guaranteed. And also don't forget to put commissions in. So if we do it for $2.40, that means that our maximum downside is at $2.40 or $240. We have a 5-point wide spread. So we have $2.60 worth of upside. So we got a little bit more upside than we do downside. But the biggest thing here is that we're just dipping our toe in the water. We're managing our risk by doing this spread here. And we know that the maximum we can lose is at $2.40 overall. All right. Well, do you have any questions at all out there, Callie, that you'd like to talk about? Because, yeah, unfortunately, we can't have the questions inside the chat box today, which makes me sad overall. But we'll deal with it because we'll be back next week. We'll be ready to take your listener questions next week.
Yeah, I'm really bummed about it too, Brian. But don't worry, I have a question for you. Little quiz time. So, Brian, I want you to tell me, why are we looking at a long call spread here instead of a long call?
All right. And I addressed it a little bit, but when we were looking at the FOMO trades where we were legitly just trying to participate in a particular sector with a lot of the ETFs that we looked at, when we were doing that, we were a little bit more bullish on the marketplace. Right now, we're kind of looking at catching a falling knife, if you will. You know, we haven't really settled on where the NASDAQ is going to stop on the downside. And so when I'm doing that, I kind of want to manage the risk a little bit more by selling an option contract to help pay for it. And so that's what we're doing here. If we bought the option outright, you know, we're looking at, like I mentioned, if we bought the 305, that was $9.50. So that's $950. If we went up to the 310, that's trading for $7.13 on the ask price right now. So that's $713. And that was just too much money for me to take. I would rather wait until we have a little bit of a move up and get the momentum to the upside. And then I would be more likely to go out and just buy an option outright. All right. Well, that's going to be it for this episode of the Stock Play of the Day. Please don't forget to click subscribe and ring the bell. And we'll see you this coming up Tuesday at noon Eastern time. This time we'll be live taping the Stock Play of the Day. Thanks for coming, everyone.